Hi everyone, my name is Jessica Laine and we are now at the fundamental analysis portion of this course. Okay, so when it comes to the foreign exchange market, fundamental analysis is just a fancy way of saying news. You are analyzing news data and breaking down political, economic, and social factors that drive currency markets up and down. Now, a certain news event will happen, and based off of that news event, of course, the market will react. What I'm going to be doing in this section of the course is breaking down these news events into what we as analysts call economic indicators and give you guys really insight into understanding in totality what they are, how they move the market, and how you will trade them based off of their news release. So first, please note that you can become a successful trader by understanding technicals only. And you can also become a successful trader by understanding fundamentals only. I actually have some friends that do both. I have some friends that are technical analysts that don't look at fundamentals at all. And I also have some friends that are just fundamental analysts only and don't look at technicals at all. But please just know that your ability to understand both will put you above the edge and give you multiple confluences in your trades, okay? A lot of people struggle with confidence in knowing that they are in winning or losing trading or in winning or losing trade positions, but understand that when you understand everything in totality, it will really put you above the edge and give you all of the confirmations that you need to execute your trades. So in order for us to understand economic indicators, it's important for us to really dive into understanding the key elements that cause the market to fluctuate each and every day. Okay, it's also important for us to understand the never-ending stream of fundamental news that lies below the surface of the obvious. So in order for us to understand this, we must first actually understand what economic indicators are. Essentially, they are financial instruments dependent on data and information that will show us how well or how poorly an economy is performing. And based on this news release, market makers and policy creators will literally gather a consensus on how this exact news release will perform in the future. Now, most novice traders, they'll look at Forex Factory. If you've ever looked to the right-hand side of Forex Factory and you see like a folder, this is where this data stems from. Now, as an investor, you can gather information to make an informative decision on your trades. For instance, an economic indicator suggests that the economy will benefit or worsen from a specific event. You can approach the market with a somewhat of an informed bias based off of that particular event. So there are two main attributes, okay, to economic indicators. You have pro-cyclic and counter-cyclic. Pro-cyclic indicators are indicators that move in the same direction of the economy. So if the economy is doing well, this number is typically increasing. On the other hand, if our economy is doing poorly, like when coronavirus first broke out, this number will be decreasing, okay? And a counter-cyclical indicator is an economic indicator that moves in the opposite direction of the economy. So if the economy is getting worse, right? Like unemployment rates, that's kind of like an example. So as unemployment rates decrease, the economy will get better. Now, from these two indicators, timing is a very, very key factor that comes into play. It can be leading, lagging, or coincident. Leading indicators signal a change that the economy or signals a change prior to that actual event taking place. So it's the most important economic indicator because it kind of foretells the economy's prediction. Interest rates and inflation are two examples of leading indicators, as well as stock market returns. Now, a lagging indicator is an indicator that kind of takes some time to affect the economy, such as unemployment rates. And lastly, coincident indicators are really point out the overall track of the economy, such as individual pay and retail deals and somewhat of that sort, okay? So like that's kind of a brief introduction into fundamental news. In our next video, I'm going to be breaking down how this correlates to our economic cycle. So stay tuned and I'll see you guys on the next video. Hi everyone, it's Jessica Laine, and in this video, I'm going to be going over a very critical issue which isn't talked about too often, which is the similarity between the monetary cycle and fundamental news, okay? Like economic indicators, fundamental news delivers a cyclical relationship depending on where we are inside of the financial market. So let me break it down like this. Anytime that there's a news release, price movement will be dictated upon two things. Number one, the relevancy it has to the economic cycle, and if there are any monetary policy changes that will literally occur as a result. And number two, how correlated the numbers are in relation to the projected forecast. So for instance, right now, interest rates are literally at an all-time low because inflation is so high. So the possibility of any change in interest rates are practically null and void, okay? Central banks and other investors have literally written off monthly interest rate announcements as irrelevant because really, without any anticipation of change for literally years on now, fundamental analysts will focus on other data such as unemployment, manufacturing data, and retail sales. And we'll get into that in a second. But right now, I really want you guys to understand all of this in totality, okay? So the benefit of these releases is that they start to show signs of economic recovery. So if our economy moves from a late recession into early expansion, this means that there is an increase in jobs coupled with output and production data. Therefore, inflation news will begin to be of high importance because it will show signs of economic growth as well as stability. However, as the cycle continues, interest rates will then gain higher importance because markets are there to foresee the next possible recession, moving us from an early expansion to a late expansion. And once this occurs, unemployment data and manufacturing output will be of high significance because it will give us a perspective on how long or how bad a recession will be. Then the economic cycle comes back full circle because once the recession hits, interest rates will literally flatten out and the economic cycle will then start over. So the economic cycle will literally move from the late recession into early expansion, then from early expansion to late expansion, then from late expansion to early expansion or to early recession, and then we're back at square one. Every economic indicator will have a suggested forecast and expectation number attached to it. Okay, so when the news is released, depending on the context of the actual forecast, the market will literally shift up or down. If the news is good, but not better than the forecast, then the currency may decline. And similarly, if the news is bad, but not as bad as it's expected to be, the currency can rise. For the purposes of this module, I'm going to be breaking down each economic indicator and explaining its relevance and how to really understand its data. First and foremost, I want you guys to set down really some key components to help you guys understand everything. These economic indicators will be on an economic calendar, okay? There are many resources accessible to you. You know, I use FX Street and Market Watch. A lot of people use Forex Factory. Forex Factory will probably be the most comprehensive because one, it's free, but it's also reliable, okay? Now, the main thing you want to do when you look at a news release is look at the previous data to the right of the release. It will always help you understand the last year. You always want to understand the last year and the last year and a half worth of its data because it will give you kind of a context over the past previous months. Also, all news releases are color coded based on impact. So of course, red is always high impact news, which means it will literally shift the market tremendously. Then you have orange, which is medium, and yellow, which is low. Now, please make sure you guys take notes because in the next few videos, I'm going to be breaking down each economic indicator in order of its relevancy so you guys are able to understand what each one means and how it impacts the market. So I know that was kind of like a handful, but that's really fundamental analysis for you guys. So I will see you guys in the next video. So stay tuned. Hi everyone and welcome back. Of course, I'm Jessica Laine. You guys already know to take notes because now I'm going to break down the first economic indicator, which is gross domestic product, okay? So gross domestic product is also known as GDP. It's one of the biggest and most important economic indicators there are, right? So it's the key economic indicator for banks and governments in which all central banks, the World Bank and IMF watch it to understand where the economy is going. Governments use this number to really predict spending as well as plan. So earlier I talked to you guys about, leading and lagging indicators, and lagging indicators, gross domestic product is a perfect example of it. Okay. Gross domestic product is typically released quarterly because it lets us know whether the economy is expanding or contracting over the previous 3 months. When looking at these numbers, it's important to look at the market expectation in relation to the previous number. This tells us if the economy is developing a trend and how the currency will be affected. Gross domestic product is measured in regards to expenditure, output, income. I definitely feel as though these words are kind of like self-explanatory. However, expenditure is the amount of money that is spent. So output are the goods and services produced, and income is the generated profits and wages. So when looking at GDP in regards to trading, it's important to see which number is preliminary, the interim number, and the final number. Sometimes people wonder, why doesn't the market do a complete shift when GDP is released? And this is because it depends on which number is released. The interim and final numbers don't push the market like the initial number does. Now, in regards to these numbers, you have to understand what the number is saying about the economy, how it correlates to the expectation of the market, and how fast or how slow the economy is growing by the data and what trend is really projecting. Okay. Is the economy shrinking? Is there a change in the economy, or is there a continuation? Now, a positive release for gross domestic product is attractive to investors because it indicates growth, a strengthened economy, interest rates increase, but please understand that the number varies on expectation. I say that because just because a number is positive doesn't mean that the market will rise automatically. If it's positive, but not in line with the expectation, then the number won't surprise the markets. However, if it's better than expected, then this is normally good for news for the currency, which will really make it strengthen as a result. Now, if the percentage is positive, but not really reach the expectation, then the currency can drop momentarily and react. Also, if the number is positive, but not as good as expected, then it could drop and really signal that the economy is not doing so good. Now, it really works the exact same way for negative numbers, but I really want you guys to understand gross domestic product, because in the next video, I'm going to be going over CPI. Okay. So I'll see you guys soon. I know this was a lot. However, again, take notes and really take heed to what I mean when I'm talking about the actual versus the expectation number. Hi, everyone, and welcome back. In this video, we're going to be going over CPI. Okay, so CPI stands for Consumer Price Index, and similarly to GDP, it is watched by central banks and governments, right? However, on the contrary to GDP, CPI numbers are released monthly opposed to quarterly. Okay, this is a key economic indicator because it measures inflation. And as a result, it gives us a pre-glance into upcoming interest rates. The data is a total of thousands of goods and services that are broken down into really 8 various categories, such as transportation, food, apparel, housing, and so on, right? Now, you don't have to remember all 8 of the categories. It's very important for us to understand this release. Okay, so when Consumer Price Index is reported, it's reported in 2 ways. Regular CPI is the first one, then you have core CPI. When we talked about GDP, the first number was the most important. However, here, policymakers consider core CPI as the most important. This is the one that's typically shown on the economic calendar, and it's considered more important because it gives us a more accurate depiction of inflation long term. Now, the way we use this number is similar to GDP. So again, if the release is positive, then consumer prices are rising. And if the number is negative, then they're falling. But again, it's important to really measure the actual number against the expectation number, because the market's reaction to these numbers are based on the market's perception of how the data will be interpreted by policymakers. Okay, so I hope you guys were really really able to take some key points away from this video, and we're going to be talking about employment data next, so stay tuned. Hi everyone, it's Jessica Laine and welcome back. So I'm super excited to break down employment data because this is what people trade when they trade NFP. And you know, a lot of people trade NFP and have no clue what it means, how to capitalize off of it. Like, it actually amazes me how many people are willing to give monetary donations to a market of such dominance just because they chose to cut corners in their research. So it's my hope to help you guys acquire the right knowledge to enable you to become profitable from one of the most profitable days that people love so much, okay? So if you don't already know this, like all across the world, traders jump for joy anticipating the first Friday of every month at approximately 8:30 Eastern Standard Time. Non-farm payroll is released by the U.S. Department of Labor, okay? And what it does is give the world insight into the jobs market for the biggest economy in the world. That alone makes it one of the most volatile news events there is, but I'm going to break down this in fundamental as well as technical terms to give you guys insight. So the job market is essentially the bread and butter of the economy, okay? Without jobs, there's literally corruption. And seeing as though the United States is currently the largest economy in the world, non-farm payroll has an even greater significance. If the United States does not have jobs globally, every other economy will be affected as well, right? There's literally a ripple effect that stems from the United States, whereas if the United States is not producing, all other economies will eventually be slowed down. So, like every news event, we must always understand the concept of comparing the actual percentages and number to the forecast of that news event. Comprehending whether the market is better or worse than anticipated will lead to sentimental analysis. So if there's a disconnect, you guys can definitely expect the dollar to be extremely volatile. Now, non-farm payroll has two numbers that are key. You have unemployment rate as well as job statistics. These are the headline unemployment rate and the number of jobs created or lost in the month. The unemployment rate is the percentage of people unemployed compared to the workforce. If the unemployment rate is decreasing, then investors will be confident in understanding that there's a level of job security, which means economic growth. If unemployment rates rise, this means slow growth and bad news for the economy. The same goes for job statistics. As you can imagine, a decrease in job leads to a decline in the economy, and an increase in jobs leads to economic growth. Job statistics are reported as a positive or negative number and typically watched the closest. So in regards to affecting the US dollar, a strong release leads to a higher interest rates, making the dollar desirable for investors. On the contrary, a weak report will literally drive the US dollar down. Low rates mean that the US dollar is less attractive, which means investors will take money out of the market and look for other assets or investments to invest in. So that's it for unemployment, guys. In the next video, we're going to be breaking down PPI, so I will see you guys soon. Okay, guys, it's Jessica Laine and welcome back. So in this video, I'm going to be talking about trade balance, okay? Trade balance is more of a global economic indicator, and as a global economic indicator, trade balance is reported by almost every economy and will affect that economy's currency. So when looking at trade balance, the impact stems from a country's imports and exports of goods, okay? So the release is having a good or bad number that's reflective of a country having a trade deficit or a trade surplus. So a surplus being as though the country's exports are more than its imports, and a deficit meaning that the imports are more than its exports. So let me break it down like this. If a country imports more than it exports, then the economy will eventually have massive debt because there's more money leaving the country than coming in, related to your everyday life. If you're spending more money than you're actually making, then you're going to be broke. However, if you have a lot of money coming in, then you'll be more financially stable, right? So for a country, this is their trade surplus. So if there's a surplus, then the country's currency will be more in demand, which means that the country's currency will strengthen. However, if it's a deficit, it will cause that country's currency to weaken. I really hope that this video was really kind of self-explanatory, but I really hope it was able to help you guys really put this in perspective. In the next video, I'm going to be going over housing data, so stay tuned. Hi guys, it's Jessica Laine and welcome back. So for the last and final economic indicator, right, we're going to go over housing data. Now, when we're looking at housing data, it's very interesting because it's a frequent news release, which means that traders don't really take it into consideration due to its frequency. But if you're looking at Forex Factory and you don't particularly see a red folder beside it, that's because traders really look at it as boring, right? However, it's important because it gives us a broader insight into what's actually happening in the economy. So earlier when I talked about economic cycles, is very similar to that. So when we're looking at the different sectors, the housing sector is very sensitive to interest rates because mortgage rates changes are based off of interest rate changes. And economists and analysts will watch for longer term trends in housing. So when analysts are looking at the news release, the housing market gives us insight into consumer confidence and consumer spending, right? And the more confident consumers feel, the more they're going to spend. The more they spend, the more the housing market will be in demand. And ultimately it shows economic growth. So inside of this sector, you have home sales, you have building permits, you have loan and mortgage data. You don't have to really know them all in detail, but the most important thing is really being able to see how this market is really given out and like understand how this economic growth will either increase or decrease. Now, I know it was a lot of information, so don't feel overwhelmed because as I mentioned, I keep emphasizing that I have trader friends that are technical analysts only, and I have trader friends that are fundamental analysts only. However, you understanding both will put you above the edge. But when it comes to news, I just gave you guys the best possible explanation of the most important economic indicators there are. But again, when understanding them, it's very important to grasp some key factors. First off, the ability to have your own thought process and trading is paramount because there's so much news out there, okay? And as an investor, you have to understand how our economy works and how things are affected. Like I broke down the main economic indicators because with the surplus of articles that are released every single day, I want you guys to really understand by weight what is the most important, okay? It's common sense to really understand positive news affects the market in a good way and negative news will really have a decline. However, I tried to break down in detail the understanding of the actual numbers compared to the expectation and the perceived or the forecast, because even if a number is positive, if it's not good as expected, a currency can still drop. Okay. And that goes the same for a negative release. Fundamental news isn't something that you can just hear and like have it all in one sitting because it's continuous information that shifts the market each and every day. However, a lot of the key factors that I just broke down will help you guys save a lot of time if you can grasp the principles and apply them to everything. You know, for news releases, again, I use FX Street and I use Market Watch. However, Forex Factory is great. It's completely free. And as I've already mentioned, Forex Factory literally color codes all their news release to help you guys understand its impact. Just remember how important it is to look at the previous releases so you can understand the past correlation to the actual or expectation of what is happening now. Okay. Again, I'm Jessica Laine, and I hope you guys enjoyed this portion of the course.